If you have a fixed rate mortgage, you need to watch this video. I was right in 2020 and 2021 when I said rates were going to go up and that you should lock it in, and I'm right about this too. But first, let's take a little walk down memory lane to see how we got here.
Perfect. And the budget will balance itself.
The federal government's deficit spending is unsustainable unless it's reined in.
Let's cut that Disney Plus subscription.
The governments have a big role to play. They can incentivize investors and builders into this market.
From April to May, Canadians saw the steepest monthly rent increase in 3 years.
This year was particularly hard for a lot of Canadians, and some more than others. And I feel like some people believe they really dodged a bullet when they locked in their fixed rate mortgage payments and locked in some of those lower rates. And for the most part, that is true. They were able to avoid all of the rapidly rising rates and rapidly rising payments that a lot of other people were left suffering from. There will come a point though where your mortgage does come up for renewal, and when that happens, you're going to be stuck just like everybody else renegotiating at these much higher rates. Well, there's a couple things that you can do in advance of your mortgage renewal date to save yourself from that mortgage cliff, that impending doom of having to renew at a higher interest rate.
Would you like to see?
Yeah.
The first is utilizing prepayment options, but don't skip ahead just yet. I feel like a lot of people, when they hear prepayment options, think they know why and how they should be using it, but I actually think most people are missing a few key details. And these are particularly going to become relevant, especially in this economic environment, when you go to renew your mortgage in a few years. Prepayment options typically give you the ability to put large lump sums against your mortgage or to increase your mortgage payment by a certain percentage, usually 10, 15, or 20%. And in this particular case, what you're going to want to do is use the latter. You're going to want to instead use your money to increase your mortgage payment that you pay every single month or bi-weekly, however you're set up. The reality is a lot of these Canadians that are suffering right now, it isn't because they can't afford to make the payments. For some it is, but for most people, it's not that they can't afford it. It's that they're just not used to it. The reality is if the Bank of Canada had chosen to increase the interest rates over a longer period of time, most Canadians would be relatively unaffected by the interest rates. It's not where we got as far as interest rates are concerned, it's how fast we got there. So by using the prepayment options that allow you to increase your payments, you can increase your payments when you have the ability to, so that you could slowly start getting used to it for your upcoming renewal. It's also going to obviously decrease the amount of mortgage that you're going to have so that when you come up for renewal in the few years that you have it, that interest rate, even though it's going to be larger, is going to be applied against a much smaller balance. But here's where it gets a little bit tricky, and you're going to have to understand something about scheduled amortization and effective amortization. Right now, what you're seeing with static variables is a lot of people who are hitting the trigger points and the trigger rates. And you're hearing a lot about that in the news. Because what's happening is a lot of people, their interest rate is climbing and more of their payment is going towards interest than principal. To counteract that, what a lot of lenders are doing is they're increasing the amortization behind the scenes. They're increasing the effective amortization behind the scenes to build in that interest into the mortgage. But when their mortgage comes up for renewal, they're going to have to revert back to the scheduled amortization. And that's where it's going to get really, really tricky for these people on static variables. With your fixed mortgage, it actually works a little bit in reverse of that. By making prepayment options, what you're actually doing is reducing your effective amortization. So you'll actually be lower than what you otherwise would have been scheduled to be on track for, because you're using prepayment options to drive down the principal. So what happens when you get to renewal is that these lenders are going to use the effective amortization when calculating your mortgage payment. And that mortgage payment will end up being higher than you otherwise would have had you followed your scheduled amortization. Now, under the switch transfer rules that exist right now, a lot of lenders still can revert you back up to that scheduled amortization. So use your prepayment options right now to get used to the mortgage payments and drive down your mortgage principal. But when you do get to renewal, make sure that you're dealing with someone that knows how to request you go back to your scheduled amortization. Otherwise, your mortgage payment might end up being much larger than you would otherwise have to endure. The second thing that you're going to want to do is make sure that your debts are in check. When you first got your mortgage, you did so with a much lower stress test. And given that there's no change at least planned for right now for the stress test, you're probably going to have to renew at a much larger stress test than you originally qualified for. And if you've increased your debts since then or somehow screwed up your credit report, you may not qualify for the mortgage that you already have. or at the very least, you may not qualify to move your mortgage from one lender to another lender. And what do you think is going to happen when your current bank understands and knows that you actually don't qualify to leave them? You're going to end up with an interest rate that is going to be higher than you should otherwise be getting. Your only other option to leave them at that point is to make sure that you have enough equity in your property, which is more than 20%, and do something called a refinance. And a refinance is always done at a significantly higher rate than a switch transfer. So if you want to avoid all of that headache, make sure that your debts are in check and you can qualify for the mortgage that you have now at the new higher stress test. And if you're wondering if you would qualify, feel free to reach out. The third thing that you need to be doing if you have a fixed rate mortgage, but you're planning on selling and buying a new place, is look at your portability and assumability options. So portability is the ability to take the mortgage with you if you were to move. It makes it portable. And this has really been a benefit for a lot of people that we had locked in 2020 and 2021 that decided that they were going to move properties. We actually estimated that we saved people somewhere in the neighborhood of about $250,000 worth of interest just in mortgages where we ported keeping their existing mortgage low interest rate and taking it with them to their new place, allowing them to continue out the rest of the term. So if you're planning on moving, make sure you're at least looking at that option to keep the interest rate for yourself. It also lets you avoid the penalty, which is another good side benefit. The second thing, though, that you need to be looking at, though, is assumability. And that's if for some reason portability doesn't work, because portability isn't a perfect science. It's sometimes difficult to get the property possessions to line up in a way that allows you to do it, or maybe the property itself isn't necessarily a fit for the existing mortgage lender, so they're not going to allow you to port it over. It might be of value to the buyer buying your house. And in some cases, we saw that a home actually sold for $8,000 more than they would otherwise have sold it for because they included their low interest mortgage as part of the deal.